So you were talking earlier about exploiting the speed of light across all asset classes in the panel. Is this actually something that we are doing, and to what degree are we doing it?
I think saying that we're trying to exploit the speed of light is probably a bit premature at the moment. I think one of the key questions that we have to address is how fast do we actually need to be? We do get a little bit sort of sidetracked as we talk about this thing, because there's a mixture of technology, of process, of business, and of course the regulatory framework which we operate. So all these together actually then give us the one figure which we always talk about, which is latency. And latency, and what everybody will tell you is, I'd like to trade as instantaneously, without any kind of change.
Do we think that that's ever going to be a possibility? Interestingly enough, particularly in recent weeks after the discovery of potentially faster than light transmission, if that ends up in the world of data.
Wow, that's a very, very interesting point. Would we say it's possible? Of course it's possible, because as we know, with technology the way it goes, we're getting quicker and quicker, but there are physical limits. And every time we halve these limits every year or 18 months, as Andy Grove said, we start getting closer, but we're doing smaller and smaller slices. So whereas a few years ago we're talking about, 10 years ago we're talking about seconds, then we're talking about milliseconds, then it came to microseconds, and now it's the nanoseconds. And as we start getting to the nanosecond field, it literally is hitting the physical limitations of the universe, effectively.
So do you think it's even possible anymore to be a market player without engaging in high-frequency trading?
Look, it's always possible to engage in the market, whether you're high frequency, medium frequency, or low frequency. One of the examples I always use is that the price that comes out on the ticker is basically a single number which has thousands of inputs into it from all over the world. It's from high frequency traders, medium frequency traders, it's from hedge funds doing value trading, it's from day traders, it's from all over the world. And everybody has a view on the price. The only problem is, or the only sort of issue then is, how do you participate? Do you participate as a high frequency trader in that flow? Do you participate as a medium frequency or as a low frequency? And this then comes back to your appetite for risk. That's basically it.
And talking of this race of speed, is that obviously is not the only factor. And how important is it then to look at the things like the audit trail and new regulations that are coming in? That surely is going to affect your overall latency. And what latency then do you report? Do you report the one that includes this overall time, or you are just looking at point A to point B and the trade?
No, I think any meaningful discussion of latency has to incorporate all these factors. It's the point, let's take a simple example. Latency is composed of how quickly you place an order, how quickly you get executions back, and how quickly you get market data updates coming through. That is the classical description of latency. And when we're speaking in the technology space, that's all we look for. But really, sort of there's other factors. In some respects, what we have to sort of describe is, when we sort of start discussing latency, we have to say, how quickly do we get to the point where we're going to make a decision to go into a trade? How long are we going to stay in the trade? If we've made a mistake, how quickly can we pull back out of the trade? And then if we decide to stay in that trade, how long do we stay in? And then at the point we want to move out of it, how quickly can we get out of it? And these are really sort of the things. And when regulation comes into this, one of the things that occur, it actually sort of fits straight into that particular description that I gave you. Say, for instance, if there's pre-trade checks, say, for instance, you can't short unless you've got the stock to short with. Say, for instance, one of the things you might have to do is to locate stock first beforehand, and that will be built into it. In reality, you won't go out and try and find the stock. You'll actually sort of do a pre-cache, and you'll say, I'll take out so much stock, and then I'll then slice that up, and then I'll just check to see whether I've actually overrun that limit or not. And that'll be a lot faster. But your latency has suddenly gone from not having to do that check to suddenly add in that little bit of a check. So as more regulations come, more of them will come through, and maybe the latency will go, and you might add another half a millisecond on it.
And talking with regulation in mind, consistency of the measurement seems to have been an issue that people are talking about, in that there are certain banks that have come under fire for inconsistent measurements. But when you're dealing with these fractions of time, that literally you have to think about the physics of it, not just simply measuring it as in the way that we would know traditionally. Absolutely. How fair is that?
The whole point of fairness is absolutely tantamount to an efficiently running market. What you can't have, and this then comes back to sort of, this has been sort of historical models as well. What you can't have certain participants having information before others. Because all that does, it preloads the dice, and they will always win every single time. And effectively what you'll end up doing is paying them a tax for trading, because they'll take a little bit out from every single trade that you do.
So if we can't then define specifically the consistency of measurements, if we've got to a point where we can say, well, no one quite seems to be able to be 100% consistent in an agreement, would that necessitate perhaps even putting a speed limit in place?
Well, the question then arises, whatever speed limit you choose, how do you enforce that? And how do you make that consistent and fair across all market participants?
So finally, what would you say, from architecturally speaking, then are your largest challenges in terms of high frequency and latency?
High frequency and latency, really, in terms of architectural challenges, is keeping abreast of the market, what's actually happening in terms of technology, applications, novel approaches, and what the exchanges are doing, how they're sort of progressing, and how the regulatory environments are progressing. So the combination of these then gives you a refresh maybe every 6 to 9 months of a rethinking what you're doing, how you're doing it, and what was even say 2 years ago, what was just on the horizon suddenly starts becoming more mainstream. And to use a much maligned word, even the cloud has started appearing in the in the horizon.
I think it's a whole other discussion. So thank you very much, Jogi.
Sure. Thank you.